Hello and welcome to this week's Market Minute. I'm Darrin Cohen, CEO of Wealth Enhancement and Preservation. Last week was a tumultuous week in the market, largely driven by a wild increase in the Fed funds rate, the largest increase in 20 years. So we saw the market go both up and down 3% in the same week, ending with the S&P down less than 0.25%, while the NASDAQ was down about 1.5% significantly. So you've heard us repeatedly talk about the economy being in good shape, and we don't see a sign of a recession. It sounds like we're kind of nuts with the market being as tumultuous as it has been lately. I wanted to point to some data that comes to us from ClearBridge, a great firm that does some research on the anatomy of a recession. And as you can see here, they update this monthly. We're waiting on the April numbers to come in. It's always the month after. But we still see an overall sign of green. I was actually at a conference last week where they spoke and they said it's still green at the end of April. They saw some minor adjustments down. And if we put that into comparison, if we look back at the last 8 recessions, going back to 1970 to 2020 and the COVID recession, you could see on the bottom the overall signal was yellow or red every time that we were in or heading toward a recession. Right now, still very green. You can see the breakdown between consumer variables, business, and financial. And we see green across the board because individuals are in great shape, making money, earning, job, wage growth, saving money, less debt than ever. Corporate America is in large-scale earnings. Again, low debt, high cash. So what does this mean? It means we need to be careful about overreacting to the current conditions and fear that's in the environment. Now, we are making adjustments. We are de-risking in our models. However, we don't want to overcorrect, like I said. Here's a chart going back the last 20 years or 2001 to 2020. So as the average investor during that period, while the stock market was up 7.5%, earned just a hair under 3%. And we've gone back, we've seen this for 50, 60, 70 years, that historically, the average investor underperforms by about 4 to 6%. The reason is not because of fees, it's not because of bad investment selection, it's actually because fear and emotions get in the way. And we tend, as human beings, to want to sell when things look bad and when the market is actually about to go up. So it's important that we use fundamental economics and real metrics and data to make these decisions. However, if you have questions or concerns, give us a call, 678-739-0175, and check out the website, wealthep.com. We'll talk to you next week. Thanks so much.